title of our webinar today, Tracking the Recovery, Inflation Pressure, a Symptom, Not the Cause. So Robert's going to dive into that in the second half of our webinar. I'm joined today by Robert Michaud, our Chief Investment Officer, and our Senior Research Analyst, Joy Zhang. Also, I'm going to go in advance here. Remember, have your trusty wealth management consulting team in the West and East to help you with any questions, concerns, comments, help with investment proposals, whatever it is you need. We're here to help support your business and your clients. And also, we have people coming to us from a lot of different platforms here today. A longstanding partner of ours, AssetMark, the InvestNet platform. We partner with some major broker dealers such as Cetera, and then as well as Advisor Group, as well as some smaller broker dealers. And then you can also directly access New Frontier as registered investment advisors through some of the major custodians, Schwab, Fidelity, and TD Ameritrade. And so with that, we're going to start off with a poll question that we've started out on the web earlier this week, social media. We'd like to see if you guys have a second to answer this poll and get your opinions and share the results. And there it is, a few seconds. What is your top investment concern going into 2022? Inflation, geopolitical developments, interest rates, or COVID in year 2 here. So I'll take a second to answer that. We'll get some results up. And it looks like our results so far show interest rates were one of the top things on everybody's mind right there, right with inflation. They're kind of coupled together. So we're going to touch on that today as well. Before I turn it over to Joy, just really quickly, we're going to start with a performance review, both for the quarter and the year. So we're going to share both sets of numbers. And then we're going to turn it over for Robert to talk a little bit more about some economic insights, both historically and going forward. And then we'll answer Q&A. And so with that, Joy, why don't I turn it over to you?
Awesome. Thank you, Jesse. And thanks everyone again for being with us today. I'm Joy. And so in this section, I'm going to give you an update of Q4 performance, focusing on our portfolios and asset classes we invest in. So let's jump in. We know Q4 ended strongly, consistent with major trends we saw in 2021, including the dominance of US large cap. The biggest technology companies continue to dominate the news, Apple, Tesla. But interestingly, if you look at the performance at the end of year, the biggest stocks, they actually performed on par with large cap asset class. As you can see, I plotted 4 indices here, and also equal weighted S&P. And they all ended the year with similar returns. So what that means for us is that the influence of the biggest stocks on the market is not as big as you might have thought. In this case, large cap asset class matters. But no one can deny that this year was a great year for large cap and also other equities. Global equity was up 7% this quarter and 19% for the year, which is 3 years in a row for a double-digit return. And supported by strong performance of US large cap, US markets continue to outperform the rest of international markets. Small cap, on the other hand, returned about half of the gains of large cap. But hey, pay attention, small cap value, they keep pace with large cap asset class, and large cap value actually outperformed small cap value by 25% this year. And that's a great outperformance we haven't seen for the last few years. And this is greatly benefiting from the economic reopening earlier this year. So other 2 equities that benefit from recovery this year are high dividends and US REITs. So US REITs was the best performing major asset class for 2021 with total returns of 40%. And also in this inflationary environment, we're seeing that US REITs benefit from its hedging characteristics as rents and property value tend to increase when prices do. On the other hand, we got main detractors that include emerging markets, especially China, Pacific, and small cap growth. And Robert, in his section, will talk more about China, and the single country allocation to China is no longer part of our portfolios. And next, I'm going to talk about yield curve. So during the quarter, we know that after Fed announced a tighter than expected monetary policy in November, yield curve shifted up from green to blue curve here, and also flattened, and reflecting that markets were priced in rate hikes in 2022, and also the long-term inflation expectations subdued. And we know there's an update in January that further changed the yield curve, and Robert will also talk about that in his section. So let's move on to fixed income performance with yields change in mind. US aggregate bonds had a flat quarter and a negative year. Due to yields change, loan treasuries were the best performing bonds for this quarter, but were down 4% this year. Along the inflation, which is continued to be the concern for investors, US TIPS were one of the best performing bonds for this quarter and this year. High yield, on the other hand, did better than investment grade corporate bonds this year and a quarter, mostly because they recovered from 2020, and also they have higher resilience to inflation and less sensitivity to rates change. The one more thing I want to highlight here is municipal bonds. They outperformed their taxable counterparts this year, and that in part explains the reason that we see a small difference in performance between our tax sensitive and global core. So in the end, international treasuries were the worst performing bonds this quarter and this year, largely due to stronger dollars. And across the portfolios, we have a modest exposure to international treasuries, so that didn't hurt the performance that much. So that is the asset class performance. And let's move on to performance on the portfolio level. And I would like to show our indices first. So here we have 6 global indices from NFGII to NFGEI, each representing the risk profile from 2080 to all equity. So what's so cool about having index is that our indices check the global portfolios in real time. So what that means is that you can check our performance in real time, and which gives you full transparency into our investment process. If you wonder, what's your 60-40 global investment doing during the day, look up NFGBI on Bloomberg, Yahoo Finance, or our website. You can get the performance directly. And here I'm comparing our indices to the blended benchmark for this quarter and for this year. So 2 highlights. Ours outperformed the benchmark this quarter, and for the year, our performance are roughly on par. And next, I'm going to give you an update of our portfolio performance. Here we have global core and tax sensitive. So all portfolios delivered positive returns in Q4, adding to strong annual performance. You might have noticed that tax sensitive performed pretty much in line with global core, and of course, because they are total return portfolios. What makes tax sensitive different and special is that it has tax efficient aspect of optimization, which means it has more tax efficient asset classes like munis and large cap growth, which explains some of the difference in performance here. And as we know, the fixed income posted flat returns this quarter. So portfolio returns largely came from the equity portion. And that's why the aggressive portfolios did better than the conservative ones on an absolute basis. And fixed income in the portfolio is for risk management. And I like to highlight a single country allocations in our portfolios, specifically Switzerland and Canada. So Switzerland, as a diversification to Eurozone exposure in our portfolios, was up more than 13% this quarter, greatly enhancing returns for the portfolio. Canada, on the other hand, was a very special case. It's often underrepresented in many global portfolios. We have that to efficiently capture economic growth globally. And Canada, for the year, returned more than 27%. So both of them help us this year. In the end, as mentioned, rates greatly benefit portfolios. And in this slide, which is my last slide for my section, we have multi-asset income portfolio performance. And this is truly a remarkable year for multi-asset income, not only on the relative basis, but on an absolute basis. We're looking at numbers 3 to 5% for the quarter, almost 10 to 17% for the year. They fully recovered from 2020, as we saw US high dividends had a remarkable year. And not only about total returns, multi-asset income portfolios are consistently providing yields from 3% to 3.6%, which is double the yields provided by broad equity markets and fixed income. And among the asset class, US dividends and rates greatly drove the performance. So that is a wrap up of our performance. And with that, Robert is going to talk more about the changes we have made during the fourth quarter. And I'm going to pass it over to Jesse.
Great. Thanks, Joy, for the update on all three model portfolio sets. Again, MAI had a stellar year, but it was coming off a 2020 where income struggled. Both tax managed and traditional also did well. And I think it just, you made a good point that risk assets did really well again in 2021. So I think we have another poll question before we turn it over to Robert. And so this next poll question, a conservative, balanced, or aggressive, which portfolio is going to perform better for 2022? So how do people think of the markets going forward? Take a few seconds, try to answer that. We'll show some results here. Okay. Okay, look at that, the trusty old 60-40, and it's not your father's balanced portfolio. This is the new optimized New Frontier solution. So looks like 60-40, when you don't know if aggressive or conservative is going to work, just pick the middle of the road, throw for the middle. So, hey, Robert, why don't you take over from here and give us an update on the markets?
Thank you, my middle of the road friend. Okay, so let me grab control of the mouse and I get to talk about investments, my favorite thing to do. Before I get to talk too much about investments, I want to note that we made some asset allocation changes recently. Technically, the tax sensitive portfolios aren't last quarter, but they were just traded last week. And we rebalanced all of our global core models in December. And so it turns out that these were, again, you know us, we're not trying to bet on the future, but we were looking at the market environment. We were looking at the things that Joy has told you, the rising rates, some increasing volatilities, and to deal with this, to make sure that our portfolios were still optimal for our current understanding of the risk and return relationships across all global asset classes, we rebalanced our portfolio. And this was a little bit unusual in that it involved some changing of ETFs to better serve those goals. One was the removal of China. I'll talk about China a little later and why that was, but the main theme there was that it was adding risk to our portfolio, and we weren't sure that it was still keeping our portfolio fully efficient. There is also an addition of min-vol developed markets, EFA. This is our second min-vol portfolio, and this really helped us to enhance risk management on our portfolio. It actually allowed us to slightly increase exposure to equities, which means decrease exposure to fixed income and duration, while maintaining the overall portfolio risk targets, right? We're always thinking about how the whole portfolio behaves and make sure that the whole portfolio is well risk managed and delivering the types of risk exposures that you're expecting from us. And then, of course, there were smaller things in the rebalance as well, dealing with yield curves and taking some gains from large cap stocks and REITs, which you saw did extraordinarily well. So I will move on to what's going on now and what happened and explaining last year. So inflation is the big theme. So it's quite nice actually that you guys seem to all agree that we should be focusing on inflation, interest rates, the economy, what this all means, paying a little less attention to the pandemic, and a little less attention to, although scary things are going on in Taiwan and Ukraine, to maybe be a little bit less focused on geopolitics. Although, the one thing I want to say about geopolitics is that I certainly hoped that we were beyond that. It's a little distressing to see some returns of imperialism around the world, and but you don't want to. Hopefully, some of it there's more show than what we need to worry about, and you don't invest for World War III. You invest for risks that you can manage. So Chinese regulations are a big reason behind some of our recent moves, and 2021 was an interesting year. So on to the pandemic. So I really don't want to talk too much. You don't want me to talk too much. Omicron, thankfully, not only is it the most boring letter in the Greek alphabet, but the markets are largely shrugging it off. In part, this is because that it's being dealt with reasonably. It's something that we expect at this point, but we can't completely ignore things like this because they do still affect policymakers, the Fed, and things that really do affect the economy. So that brings us to inflation. We just saw Powell there. The Fed stopped using the word transient, and I personally was very grateful for that because it really just added to the confusion. What do they mean with transient? Are they really saying that prices are going to go up and then come back down? And I don't think reasonable people actually thought that. So the debate was whether prices would go up and inflation would accelerate, or prices would go up and then inflation would go back down to more reasonable levels. So no one is expecting anymore that prices will go up and come back down to where they were a couple of years ago. And one of the reasons why is because many prices are just sticky. Once you give someone a raise, you can't take it back. Once you reprint your menus, then why would you do that? Your customers are paying those higher prices already. So, but there are some other things that not all inflation is the same. So this really scary 7% that we see over on the chart here is clearly a high number. Inflation expectations have already, for the future though, have already gone down dramatically. And you want to differentiate what types of inflation you're thinking about and what types of inflation you're concerned about, especially from an investment perspective. There are many other prices that, while they're unlikely to go all the way back down, are partially sticky. Things that I call retail commodities. Supermarkets, prices won't go away forever if people express a willingness to buy something at a higher price, but there is supply and demand going on there. On the other hand, you have commodities, which are fully market equilibrium priced, and supply and demand really affects those. So just to show you what's going on with the commodities, again, not all commodities are the same, right? They all are susceptible, but in different ways, to supply chain issues and demand volatility, and they react very differently to it at different points in time. So it's not just one inflation number and everything goes up at the same rate. And so I picked some of the more interesting commodities, and being the amazing artist I am, I tried to color them somewhat appropriately, like lumber. Anyway, so what we have here is we've seen there are some very big spikes, and some things go up and then down, some things go down and then up. And interestingly, in this group, they all did kind of end up in the same place, curiously enough. I wasn't even trying to do that. But but we see that they're highly volatile. I actually snuck Bitcoin onto this graph because we all know how volatile that is. And that's not really out of place in the type of volatility that we've seen in commodities. Bitcoin hasn't been more volatile this year than it's ever been in the past, but all the other commodities really have. So interestingly, on the bottom, the one thing that doesn't look like it's gone all over the place is gold. Gold, I'm not trying to say gold is the only thing you should be interested in, but I try to be as agnostic and neutral and fair as I possibly can. But we just want to point out gold has definitely not experienced the type of volatility that all the other commodities have. And why is that? Gold is different, right? There's a big difference between a consumable commodity during a pandemic when you have supply shocks and demand shocks and an investment commodity. So all of these other ones were really thrown around by the pandemic and the massive changes from one time to the next that the economy experienced, but gold was not, right? Its investment commodities have a different reaction to things. They can be more stable, certainly in a situation like this. And you should also think about that when you're considering them as an inflation hedge, because they might not be happening at the same time as when you're thinking about inflation. And I think the last thing I want to say about inflation being different is we are really focused on it, obviously, here in the US. In the rest of the world, inflation has been happening, but you might have expected from some of these huge increases in commodity prices and, aren't manufacturers having to pay much more for their labor and their other commodity inputs. So why hasn't inflation been so big around the rest of the world? I don't have time to talk about all that, but I do want to point out that inflation has been higher, especially in Europe and Canada, but it has not been nearly as high as you might expect in places like Japan. They're glad it's slightly positive. And China also is one place that you'd really expect to see inflation, and there just hasn't been inflation there. If you look at the rest of the emerging economies, and if I had shown you this graph 5 years, list of inflation in emerging economies, it would have looked roughly like this anyway. There would have been one country on there where politics messed with a central bank, and then you had the case of Turkey where something like something not good happened, but otherwise you would often see high inflation over there. So it's not just the US, but it's also not quite as bad in the world as the US picture might lead it to believe. And why is that? Well, a lot of it has to do with the economic situation in the US has been really stable. The world's largest economy, but we also had the world's largest stimulative bailout, pro-economy response to the pandemic. And we see this paying off now. We see the very low employment rates. There's some questions there about how good is it to have a lot of job turnover. On one hand, it's great when people go to more appropriate places with good skills, but there's a lot of market frictions there as well. And no one likes going into empty restaurants. But we've seen a much more rapid recovery, and the economy has definitely exceeded expectations. And so that has a lot to do with market returns and the like. But exceeding expectations leads you to say, well, maybe did we do too much? And when we're seeing these high inflation numbers, it has a lot to do with the economy recovering faster than we thought. And two good examples of the different sides of this debate are Paul Krugman, Larry Summers, both thoughtful economists. On the one hand, Krugman would argue that compared to 2008, where we didn't do enough and we took too long to do it, we really did a lot and we did it fast this time. And it clearly saved us from some more serious economic consequences. That's likely to be right. But the question is, did we do too much? Did we give too much cash to people who weren't going to be able to use it in a positive way to stimulate the economy? And now we're suffering from that in terms of they're finally trying to buy something with all this extra cash, and we're seeing the inflation. So fun debate there. And but time to move on to market insights and what this means. So the Fed, good news was Powell was reappointed. So Powell being reappointed means that not only do we have consistency of the Fed and nothing surprising would happen, which is generally not good, but they were able to enact their policies faster, perhaps more aggressively, and do what they wanted to do sooner. And so we have already seen two major market actions from the Fed, the tapering initially, and then the acceleration more recently. Those aren't rate increases per se, but they are very similar in scope and direction to an actual rate increase. And they said that everyone expects that first they have to finish tapering, then they can start increasing rates. One of the things the Fed wants to do is not shock the economy with everything happening all at once. So what this is showing is that the market now very much expects the Fed to make a series of gradual rate increases. And if you look at the chart on the right, last quarter, it thought maybe there would be one rate increase in 2022. I cheated a little bit, and the blue line is just from a couple of days ago, when now they're expecting at least 4 rate increases. The market is expecting at least a full percentage point rate increase. And so when you see the short-term interest rates, I think the 2-year interest rate exceeded 1% for the first time. When you see these things happening, maybe we'll start getting some interest in our checking accounts again. That kind of thing is all very much anticipated in the course of the Fed. So that explains a lot of the market performance. So 2020 and 2021, we have to be careful. Those were exceptional. We had excellent equity returns, excellent overall portfolio returns over a time when no one could possibly have imagined markets would perform that well while the whole world is hunkering down. But it had a lot to do with a coordinated effort around the globe and economic stimulus, heavy economic stimulus, that was both consumer and corporate friendly, right? There was unemployment insurance, there were just checks being handed to people at the same time as companies were being protected. They were given loans. And so this was a good combination of both making sure the economy was doing well, making sure the consumer and the people were also not suffering too much. And we can't underestimate the role of the central banks as well, not just in the US, but all around the world. So that's not likely to happen again. Right now, we have already seen the starts of the inflection point. Joy talked about how last quarter was a reinforcement of many of the themes in terms of the success of large cap stocks and direction of interest rates and the like. Many of the same themes of the whole of the year, and in fact the whole pandemic, were continued last quarter. But if you paid careful attention, at the very end of last quarter, in the last few weeks, it seems like some things have been changing. The value has beaten growth, international markets have outperformed domestic markets, rates have risen dramatically. So I'm not predicting things. That's not what you are looking for from us, to make big bets on market directions. But it's good that we prepared for that in early December, and 2022 really will be different. So more investing insights. So politics and taxes, two things to try not to talk about any more than you absolutely have to. But it's nice that the tax hikes that people were worried about didn't happen in 2021. That I tried to give anyone who'd listen advice of saying, don't change your investment policy based on taxes, especially if you don't know that they've, not until they've actually happened. Taxes changes may not happen in 2022 even. So when they do happen, no one likes taxes, but when they do happen, one good thing is that you usually do have time to react to it, is that they very rarely are retroactive tax policies. And so don't let the tax tail wag the investment dog. keep your investment objectives where they should be. So inflation is the thing on everyone's mind, and how do you actually invest for inflation? So certainly you want to pay attention to it, but there's so much attention on it that I think it's important to remind you that inflation is not the only risk to your portfolio. There's all the other risks that are there under normal circumstances, and a few new ones. So don't invest for just one scenario, right? That is a way that you can, over time, paying too much attention to keep one thing and not paying attention to the many other possibilities, is can really hurt long-term portfolio performance and investment return. So most of you are familiar with the optimization that we're famous for, the new efficient frontier, which is a way to invest in an uncertain future. And the main idea behind that is don't focus on just one outcome, optimize over thousands of potential ways that the future could unfold, because we don't really know what exactly it's going to be, and build a better diversified portfolio for that. The other thing about investing for inflation is, you notice I said the word portfolio a couple of times. TIPS is not a whole portfolio. Your portfolio should consist of many different ETFs and asset classes and exposures in it. TIPS by itself does do a good job of hedging inflation, but gold kind of does in ways that I already showed you a little bit. Real estate does in interesting ways. In fact, all equities have some sort of hedging component to inflation. And so think about what the components of your portfolio are and how they would all be reacting to it. It is highly inefficient to rely on just one asset class for just one scenario. And we're all about efficiency here. So China. So we need to get to, why did we remove China from our portfolios, and why have we not added it back as a tactical move or anything like that? So what's going on in China is a couple of things. So slowing economy aside, the main concern and the risk is, will investors ever be able to capture the rewards from whatever economic growth there is in the Chinese economy? And we've seen some very investor unfriendly regulations that have been going on for almost a year. We've been keeping track of those. We've been making changes to China, modifying its risk over the course of the last year. And just to, so I think everybody should know about most of these regulations. And if the regulations are severe enough, then you no longer have confidence that if good things happen in the Chinese economy, whether the investors in the Chinese corporations will actually get rewarded from that. And to really illustrate this is one of my favorite little bits of research that I've done, which is the relationship between economic growth and investor return. So the top case is the US. The blue line is investor return. That's the S&P 500. The slow and steady growing one is the GDP. And then you can see that GDP has grown a bunch, but investors have been rewarded a lot for it. On China's case, I did not switch the colors. The white line is the rapidly growing economy, and the blue line is the observation that investors have not participated in most of that economic growth. Now, we had China in our portfolios for 10 years. It did actually enhance over that time period a great deal of portfolio value and was a positive contributor to return. But you have to invest in China very carefully, and this is one of those times where we're going to keep looking at it, hoping that the environment will change and we will be able to invest in it more. And keep in mind that China is still part of emerging markets, so that we do still have some exposure to that, as do most investors. So I wanted to point out the one thing that President Xi and the SEC have in common, which is that they're both making life difficult for investors to get efficient exposure to the things that they really want to invest in. In the case of Xi and the regulations, he made it difficult for investors to get exposure to Chinese economic growth through the market. In the case of Bitcoin ETFs, which I'm not endorsing or suggesting people get, just want to point out that there still is no actual Bitcoin ETF investing in Bitcoin. The best of them, I guess, is something like BITO, which is a futures-based ETF. Unfortunately, it was predictable that BITO would underperform actual Bitcoin because of the structure of these futures-based things. So on a daily basis, if you want to use it for that, 15-minute investment in Bitcoin, it's probably great for that. As a long-term investor, it's not efficient. And again, a core part of our investment philosophy is that we want to make sure that we understand the things that you find valuable to invest in, and then make sure for our that will benefit the portfolio. And then we want to make sure that the instruments that we're investing in are an efficient representation of that. If those both aren't true, they shouldn't be in your portfolio. Now, wrapping up a little bit, we have been an ETF manager since the dawn of ETF management, since 2004. And so we, of course, pay lots of attention to ETFs. A thing that has happened recently is that active ETF world has really sort of taken over and been the sort of whole investing world for, and certainly, and one of the ways that we see that is that the number of active ETFs that were launched last year, that has been over 60% of, or roughly 60% of ETFs launched last year were active ETFs. A big part of that was mutual fund conversion. So we see the likes of DFA and many other fund companies that have acknowledged that they need to be part of the ETF world, or they risk getting left behind by the investment community. Many of those have been active ETFs. Another thing is that we've seen the first celebrity ETF manager. Just a few years ago, I wouldn't have imagined that the big investor that everybody was talking about would be doing it all through an ETF because of all the transparency requirements there. And celebrities like to keep their investments hidden until everyone else has done them. So, but Cathie Wood has changed that, and I imagine that's the first of many things. Another little bit that has been in the news very recently is that fits in with these themes is the rise of proprietary models. As the ETF world keeps expanding and it becomes more of the default, there's been an incentive for many companies to release ETFs and invest in their own ETFs. And so this recent research paper is something that maybe we all should have expected, but of course, when that happens, it's not in the investor's best interest. If you haven't seen this paper, it's I encourage you all to pay attention to it because it underscores the importance of what we're doing, which is providing independent advice, putting a lot of effort into separating what are the real sources of value, what are the quality ETFs to be investing in, and picking instruments and building portfolios with only one goal in mind: to do the best job we can possibly do to maximize the likelihood of your clients meeting their investment goals. So, the truly final thing I have to say that I'm very happy and pleased to talk about is that, as you know, we are a company that was founded on a research idea, this idea of the new efficient frontier. We did not stop doing research. We are still doing research. My father, Richard Michaud, was emailing me on all of the recent holidays about the developments of this research, and so he's getting very close to having something to present to you that talks about the very exciting relationship between the Michaud efficient frontier that we build our portfolios on and some Nobel Prize winning research on expected utility. So more from that to come. And with that, I think it is time to go back to Q&A.
Great, Robert. Thank you for all those comments. I think you touched on a lot of topics that are top of mind for investors and advisors out there. And I think you made some great points about, we've been doing ETF due diligence since 2004. So just with all these new ETFs coming to market, it's just critical to understand what you're investing in. So why don't we go into Q&A here? We're already 45 minutes into the hour almost. The first one comes to us from Susan, and it's on interest rates and inflation. What is the impact of 2 to 3 rate hikes on the market? Why don't you touch on that, since you did show a slide that now it looks like there might be 4 or 5.
Okay, yeah, so hopefully to answer questions, I'll try to answer them as fast as I can, and we can get to a number of them. So, right, so there's a couple of ways to think about that. One is that they're already, if you're talking about 2 to 3 rates and we're already pricing in 4 to 5, well, that would be not meeting expectations. The market has priced in 4 to 5. The whole yield curve and equity world has adjusted to that. And 2 to 3 would be a disappointment, which would mean, if we were there, that something unexpected has happened, that perhaps the economy is not going as robustly as I thought, and the Fed does not want to take any blame for stopping an economic expansion. So in that case, the long rates would change, inflation expectations would change, equities would likely suffer. If what instead you're saying is that it's sort of a positive surprise, then the reverse would likely happen. That might mean that if the Fed has to go even faster, that's probably because the economy is going even faster. It's hopefully not because inflation is running away, which would be the worst scenario of all, which would be bad for all asset classes.
And to add on to Robert's point, only expected news will affect markets. So alongside rate hikes, if there's any other tightening measures that are not pricing markets, for example, reducing the size of balance sheet faster than we expected. So those all affect how market thinks of the interest rates going forward. So what happened in 2013 doesn't have to be the case in 2022. So I think stock bond act very differently or unexpectedly in different times when interest rates increase. So given all the situations, you stay diversified.
Yeah, I think that's important, right? We diversify because of uncertainty. So the next question that comes to us is from Ed. There's actually a couple questions here regarding our strategy and portfolio. What changes are we likely considering? And then also with that, how much flexibility is there in our portfolios from an equity fixed perspective and actively de-risking our portfolios?
Okay, so to answer the second question first, we don't think of building a stock portfolio and a bond portfolio and just giving you 60% of one and 40% of the other. We think about building a whole portfolio. So there's a fair amount of flexibility, not a lot, but a fair amount of flexibility from our perspective in terms of exactly how much fixed income and equities there are in the portfolio. And what you saw in our most recent rebalance was exactly the case of we are being very diligent about maintaining an overall portfolio risk exposure. We're not tactical. We do not go in and out of the market. And we have found that being transparent and doing a really good job to make sure that you're getting a portfolio, that you understand what investment objective it's meant for, and it consistently does that, and then let the advisor make sure that the client's in the appropriate portfolio at each point in time. So we do not have a lot of personal discretion, or we don't want to do a lot to move around the overall portfolio's risk target. So
great, Robert. On that, the next question comes from Walter, and then I'm going to couple onto this. Hey, how do you see value doing going forward this year? And I think a lot of advisors are like, when is value going to finally have its run? And maybe we saw that in the small cap area, but coupled with that, if that takes hold, how can New Frontier portfolios benefit from a rotation from growth to value if that momentum continues through 2022.
Yeah, I can take that one. So yeah, that is a very relevant question to all of us. We know value has underperformed in the past few years. And recently, in the last 3 weeks, we're finally seeing the sign of rotation from value to growth. And we know growth came under pressure because of rising inflation and rising rates. So, but we don't speculate on the future returns of value and growth, and no one knows. Well, for us, our portfolios have a balanced exposure to value and growth. So which doesn't hurt us, or even though value underperformed, the value allocation doesn't hurt much in the past few years. And if value start to outperform, it will help us. We will benefit from this rotation. So again, so diversification and have balanced exposure according to the risk profile that we manage.
Great. So let's see, next question. Let's go over to international versus domestic. I have 2 questions here, one from Gary, one from John. How should international investing figure into a 2022 portfolio? And another question, I think it's along the lines of growth versus value. I think people are going, when will international stocks finally outperform the US?
Yeah, so a lot of asset managers have gone out of business or severely disappointed their clients by betting too hard in one direction or another. And so we're not betting that international stocks are going to outperform, but we want to make sure that we do have the right exposures and to international stocks should they perform, and we want to make sure that we're balancing those risks well. So certainly there's a case to be made that there's tremendous value and potential for price appreciation in the European market. What happens if something bad happens in Europe? You don't want to be too exposed to that.
And then this one, Joy, maybe for you, there's a lot of talk in the media about inflation leading to higher long-term rates. What is New Frontier's view on interest rates and the shape of the yield curve today?
Yeah, sure. So I think Robert has talked a lot about the yield curve interest rates and how that we don't speculate interest rates. And we do have long duration bond position in our portfolios. So it's essential for us to think about these questions and carefully. So if you think the long-term interest rates, they reflect people's inflation expectation in the long term, also uncertainty around inflation. And that's why we're saying 10-year treasury approaching 2% today, and also the interest rates from the short end will affect long end and eventually. So in terms of the shape of yield curves, what we can do is we make sure that we have diversified exposure to different parts of the curves, short and long and intermediates, to hedge risks. And we think it's the big component of having and duration our portfolios to hedge risks and to maintain diversified and effective optimal.
Great, thank you for that, Joy. So with that, Robert, Joy, thank you so much. Advisors, thank you so much for your time, your partnership, and really entrusting us with client assets.